Hi, welcome to Deal Makers. I'm Sarah Sharp. I'm a deal attorney who helps people buy and sell businesses every day. In this episode, I'm going to tell you about a trend I've been seeing that is a result of the private equity entering the scene that I play in a lot. It's a downstream effect that I don't think as many people are aware of, and it's super sad. Spoiler alert. If you're new to this channel, please take a minute to like and subscribe to our content so you can get more tips from a real deal attorney. One of the things that is happening a lot in the place that I'm in, private equity is entering the scene. I do a lot of accounting practice buyout. So you see it all over the news. Baker Tilly, big deals, accounting practices, they're great to buy, valuations are through the roof, things like that. I don't see yet that there is that big of a difference in the valuation this year versus prior years, but it is enough to make a seismic shift. Before I tell you what I'm seeing, check out our courses too if you're into buying or selling accounting practices at dealacademy.org, and just engage with our content. It's super helpful. So as you may have noticed, if you're in this area, private equity is interested in buying accounting practices, something that was previously overlooked. And private equity can mean a couple different things. I like to use the term financial buyer because it's more inclusive. Whatever private equity is, family funds, guys with a lot of money, and a website and a slick name, all of them can kind of present the same. So from the seller's perspective, it's not always super clear which way you're going, but it's somebody who's buying an accounting practice for the purpose of investment. So not for the Main Street acquisition where they're going to also be the owner operator. Because private equity is entering the scene and they're used to other industries with much higher multiples, they can get really, really competitive and pay what would have previously been considered way over market for accounting practices. It doesn't happen all the time. A lot of them are still trading at the 0.9 to 1.3x gross revenue that every broker is known to believe is best. That is absolutely true. But some of them are trading a little bit higher, and the additional influx of potential buyers for all of these had this downstream effect. I am recording this now because I just saw it happen for the fifth time in 1 year where a practice was owned by somebody, and that person, in each case, it was their son. Well, actually, one case it was daughter. So a practice was owned by someone, a parent, and their child was working in the company, and they were selling to someone who wasn't their kid. And the reason for this is increasingly, with a little bit of an uptick that we've had over the course of the last few years, valuations are higher. In order to buy in as a young person with these interest rates, it's becoming really prohibitive. On the other side of this, these sellers can't really afford in this environment economically, or just because they're good business people, they can't afford to not sell their business for the max value. There's not many sellers who are well situated to say, you know what, keep your several $1,000,000. I'm giving my business to my child. That's not something that you see anymore. Back in the day, when the businesses were not so easy to transition, technology didn't exist, people were coming in person constantly, you had very few potential buyers and really no way to access them. Internal buyouts happen all the time. And I think regularly in accounting, there's this idea that you'll be able to hire a junior partner and train them up. And then when they feel confident doing the skills that you've trained them on, then you can start slowly transitioning the practice to them. 10% a year, they'll buy you out based on the income that they receive as they go along. At the end of the day, they buy you a gold watch and you all go to dinner and maybe you cheers. But I've never seen that happen in all of the years that I've been doing this, and it just doesn't happen anymore. Because what I am seeing is people wish that was feasible on all sides, but it's just not. If you can sell your business, especially with the SBA 7A loan program, normalizing a really big 90% upfront for the buyout of these types of businesses, a seller can't afford to say, well, pay me 10% year with no interest over the course of 10 years. I'll continue to work for this reduced amount. At the end of the day, I walk away. I mean, they're looking at saying, I own 100% of a company. I can get a couple $1,000,000 tomorrow if I sell it. 25-year-old who's on a relatively normalized salary working for their parents is just not going to be able to pull off that leverage. And most parents, even if their kid who's been working for the business could get out a loan and leverage themselves with that 7A program to make that happen, that's not what parents usually want for their kids. So increasingly, I'm seeing folks skipped over by their parents and having to continue working for a business that's now being owned by a third party they're not related to. That causes all kinds of problems. So one of the problems is it's sad and it makes everyone else sad. And I think that's worth pausing on, because if you are looking at buying a family business, I think you really need to dig deep into the dynamics at play. It can be really challenging as a buyer to step into the shoes of somebody who is being managed by their actual parents. So if that's the case and you're dealing with some siblings or some children, adult children who are working for a company that you're planning on buying, be prepared to really roll up your sleeves and get involved in some heavy, emotionally intelligent management styles. And the other thing that I care about as a lawyer is those adult children usually have a really good relationship with the client base because it's family-run business. Perhaps those clients have been around and saw the adult child through the years and at the practice. Sometimes the kid has the same name, the last name usually, but sometimes they have the whole same name as the seller. So you're looking at Josh Williams the third. If you're buying Josh Williams CPA practice, having a Josh Williams in the office creates a little bit of a confusion as to who's running the show. And most significantly, from a legal perspective, you can't get an employee under nearly as an enforceable of a non-compete when you bring that up. So you could have these other individuals who are really, really essential to the running of the business you're buying who can lawfully go and compete with you. And they're not an owner. So if you're buying a business, you can get the seller to agree to a non-compete, but you don't have any contractual nexus, which just means you don't have any written relationship where you and this person are a counterparty and you're both exchanging something of value called consideration. You don't have that contractual nexus with the employees until you get them under an employment agreement. So if the adult child decides they don't want to join up, you don't have an employment agreement with them and you can't keep them from going off and competing directly with you in most cases. And that can be a real Achilles heel for your transition plan. So these are some of the really unexpected downstream effects of private equity entering the scene and increasing valuations is say goodbye to family-run businesses. But I guess to put a little bit more optimistic of a spin on it, say hello to the new era where you no longer have to follow in your parents' footsteps and you can strike out on your own and build your own future. If you found this valuable, please like and subscribe to the Dealmakers channel or check out dealacademy.org for some courses on how to structure very powerful, successful deals.